Hi friends, so we'll now proceed with the theory discussion on chapter 1, which is financial policy and corporate strategy. Before I start discussing what is this chapter all about, let's first understand the term financial policy and corporate strategy. What does these two terms mean? Financial policy is basically a policy of an organization in relation to various financial measures which a company can have. So you can have a financing policy, you can have an investment policy, you can have a dividend policy, you can have a policy which will say that my debt equity ratio should not be more than 4 times. That's a part of my financial policy. My investment policy could be that I do not want to make an investment unless an IRR of my investment is more than 18%. So financial policy is basically in relation to the balance sheet of the company as well as the P&L of the company. Corporate strategy is basically a plan. Strategy is basically a plan to achieve something. In strategy, you have multiple types of strategy. You have a top level strategy, you have a middle level strategy, you also have a lower level strategy. So strategy is basically going to help an organization to achieve their goals. So what we are doing in this chapter is how can we link the financial policy with the corporate strategy of a company, because for every organization the starting point of any organization is money, and the ending point is also money. When I say starting point is money and ending point is money, if I want to start a business and run my operations, money is very critical, because money can only help me in getting all other resources which are needed. You basically need men, material, machine and money in order to run a business. So for you to get men, employees, raw material, machines, you will obviously need money. So money is the starting part as well as the ending part. That is, at the end of the year, how is the performance of the company? So let's now go through the specific questions which are there. Explain about the advanced role of CFO in various matters including value creation. Now, CFO, Chief Financial Officer of a company, traditionally used to focus on, which you would have learned at CA Inter. Traditionally, see what used to happen is, this is how operations of a company work. The CFO is in between. You have investors. The investors give money. The investors give money to the organization. The investors are going to give money to the organization. So what the CFO is going to do is he is going to collect this money and convert them into real assets. Convert them into real assets. What are the real assets we have? We have real assets like land, building, plant and machinery. All these real assets will be created by an organization or by CFO of a company by taking. So what CFO indirectly does is he converts financial assets. What is financial asset? For the investor, they will be getting financial asset like equity shares, preference, debentures. All these financial assets are converted into real assets by a CFO. So getting money from the people was called financing decision. Investing them was called investment decision. At the end of the year, you will be doing some analysis called as dividend decision. This is what CFO was traditionally doing. He continues to do the same thing, but now just that alone will not help. They have moved to newer areas or advanced areas. So CFO's traditional role was focusing only on wealth maximization. The focus was only on wealth maximization. So we were trying to create wealth for the shareholders of the company, but due to globalization, information and communication growth, the responsibilities now have increased to multiple other level. The responsibility have increased to multiple other level. So traditionally the focus was only on wealth maximization, but now the focus has shifted to advanced set of areas such as risk management, supply chain, mergers and acquisition, or ESG financing. So we are seeing a lot of new areas where the focus has shifted. So the newer set of areas which the CFO is now focusing is risk management. What is risk management? Is every organization will have risk. So what you need to do is you need to have a risk and a control matrix. Various risks which an organization faces. What kind of controls can be brought in against those risks, which is called risk and control matrix. Supply chain. What is supply chain? Is the process by which a material, the process supply chain, you learn this in SCMP. Supply chain includes all those people by which a raw material gets converted into a finished product and reaches the end customer. So supply chain management is also very critical, because if you are not having proper supply chain, you will not be able to reach the end customer. This is pure finance related role. Lot of M&A opportunities keep happening, corporate restructuring happen because of the recent growth which has happened. So this is very critical, because if you take a wrong M&A exercise, it will lead to business collapse itself. And ESG financing, environmental, social and governance financing. ESG is an area which we have seen in corporate valuation or in your business valuation. We saw what is the impact of ESG on the valuation. So ESG is a sub part of your triple bottom line or TBL framework, where you need to focus on people, planet and profit. An organization need to focus on people, planet and profit. Similar to that is the ESG framework, where you need to focus not only on the profits angle, you'll have to focus on environment, social, which is employees and the society at large, and having proper governance metric. This will ensure if you are good at ESG, you'll be able to raise money in the form of ESG bonds or green bonds, which will come at lower rate, and also it will help an organization to have a sustainable future. Next, what are the three essential elements of a business? I think as I was starting with the chapter, I said the starting point of any business is money, and the ending part is also money. Money is very critical part for any business. So what are the three essential elements of a business? One element is financial resources. Finance is very critical. Without having money in place, without having investors in place, I will not be in a position to do my business. So finance is the first fundamental of a business. Whatever finance is there, who is going to utilize that? That utility is going to be done by the CFO, or technically management. CFO is part of the management of a company. So CFO is going to use the finance which is there. CFO is going to use the finance which is there. So whatever finance an organization has, the CFO will utilize that finance, or the management will utilize that finance with the help of a well-designed strategy. With the help of a well-designed strategy, so that I'm able to achieve my financial goals, maximize my financial resources, use various financial tools available. Objective is to maximize my goals or achieve my goals and maximize the financial resources which are ultimately available with the company. So the three fundamentals is finance is the starting part. Who is going to use the finance? Management is going to use the finance. What the management is going to do, or how are they going to use it? They're going to use it with a clear and realistic strategy. Write short note on strategy. Strategy could be anything. If I ask you, what is your strategy to clear CA final exam? If you tell me some ways that you are planning to do XYZ thing, for example, you are writing your exams in November 24, May 25, November 25 or May 24, whenever you're writing your exam, I asked you what is your strategy. So you say, my plan is to complete my classes by this time. My plan is to do one revision in this month, then write one mock exam, second revision after the mock exam, write one more mock exam, third revision, write one more mock exam. That is your strategy. That strategy will give you the direction. Yours is a very short-term strategy, that is still your exam, but you can have a long-term strategy as well. So strategy is going to give some long-term direction and scope of an organization to achieve competitive advantage. How can you achieve advantage for a corporate? You can achieve advantage or competitive advantage through cost, leadership, product differentiation, or a focus strategy. You can go for a cost leadership strategy, you can go for a product differentiation strategy, or a focus strategy, so that you are able to achieve a competitive advantage in a competitive environment where my ultimate objective is to meet the expectation of all stakeholders. It's not only shareholder whose focus we have, we need to achieve the requirements or meet the requirements of all stakeholders of an organization. What are the functions of strategic financial management, or technically now the ICI has used the word advanced financial management? Basic thing is very simple. I need to ensure that I am able to achieve my objective. Is a corporate strategic plan. You will learn that there are three types of strategy. There is a top level strategy, there is a middle level strategy, and there is a lower level strategy. You will learn this as we proceed. Your SFM or the financial strategy will come in the top level, or at the strategic level, or at the corporate level, where you are planning your investment and financing decision for achieving objective. What can be the objective of an organization? It can have an objective that I want to become a $1 billion company. I want to have a ROE of 25%. I want to have asset turnover of 5 times. You can have different objective, which can be a financial objective, it can be a non-financial objective. Somewhere the investment and financing decision is going to help me in achieving this objective. It distinguishes between strategic level, tactical level, and operational level financial planning. With the senior management, the top management will take part of the overall strategy. Middle management is going to take care of the middle layer, which is called tactics, and the operational management will take care of the overseeing of operation. Now, some of the examples are some of the things which you can do. These are self-explanatory. Finding out best investment opportunity. Where can you put your money as a business? Tata consultancy services make a lot of profits. They need to ultimately use this profits for some purpose. So where can that money be utilized? They have to do a continuous planning and invest this money for some purpose. Selection of the best profitable opportunity. You find out the opportunity, you decide which opportunity do you want to pursue. Moment you decide what opportunity to pursue, you need finance to explore that opportunity. So what should be the mix? What should be the mix for the opportunity? Some proper systems are in place, and how are the results which are coming? What are the key decisions falling within the scope of financial strategy? As I was explaining the intro part, I said under the traditional approach or earlier approach, the CFO was doing some critical decision, which was financing decision, investment decision, I think dividend decision was there, and in evolving areas, I think a portfolio decision. Financing decision is how much money to raise and what should be the composition. So you are planning to find source. Source means from where you want to raise the money. Cost. At what cost do you want to raise the money? There's a cost of debt, there's a cost of equity, there's a cost of preference. Quantum, how much money you want to raise. So source, cost, quantum, all that is decided as part of your financing decision. Investment decision is where do you want to invest this money. You will take the help of your advanced capital budgeting chapter to take your investment decision. Whatever investment decision an organization does, it is with the help of what you learned in advanced capital budgeting chapter. So you will have to make your investments. What kind of investments an organization can make is being analyzed through investment decision. The focus is obviously to maximize return as well as ensuring that you have a balance on the risk side. The projects are evaluated in relation to the expected return and risk. At the end of the year, I said you'll be doing this investments. At the end of the year, this real assets will generate profit. The real assets are going to generate profit, and this profit will have to be passed on to the investor, will have to be passed on to the investors who gave money. That decision is called dividend decision. Whatever profits you have made, a part of the profits would be given back, part of the profits you may retain in the business, depending on whatever is your policy. You will have to give money back to the investor. So whatever profits an organization has generated, that needs to go back to the investors, which is called dividend decision. And an evolving area is portfolio decision. Now in portfolio management chapter, you will learn that a portfolio is basically a combination of multiple securities. So a single project, let me look at from a corporate project point of view. A single project on a standalone basis could be a good or a bad project, but when you combine it with the overall view, the characteristic or the analysis may change. Just to give an example, I have a manufacturing plant in Bombay. So I have set up this plant in Bombay. Now I am planning to go for backward integration. Backward integration is you want to go for manufacturing of raw material, which is a good project. You did all your analysis and you found that the best place to put the raw material project, the best place on a standalone basis, you are not doing overall analysis, on a standalone basis, you found that the best place to put this is in Delhi. You decided that you should put this project in Delhi because you get the cheapest raw material there. Let's assume you get the cheapest labor, all that happened, and you decided that you'll put it in Delhi. But where is the raw material going to be used? From Delhi, it has to come to Bombay. It has to come to Bombay for the usage in my project. For the usage in my project, the raw material from Delhi has to come to Bombay. And when I look at from an overall point of view, this is not a good project. When I look at from an overall point of view, I find this to be not a good project. The reason for this not being a good project from an overall point of view is that logistics cost. So what is good at a standalone level may not be good at a group level or at an overall level. So you should not look at the isolated characteristic of the investment. You should look at the evaluation of the aggregate performance, contribution to the aggregate performance, and not the standalone performance of the various securities or project. Different types of strategy, as I've been discussing, corporate level strategy is there, business level strategy is there, functional level strategy is there. Example, Tata Group, or let's take TCS. TCS is deciding its own strategy, which is going to be decided by the TCS board of directors are deciding the strategy of TCS. The strategy could be that I want to become a market leader, I want to diversify to other places, I want to add new customers, I want to add new product line. In TCS, you can have maybe 4 different segments. Segment 1, segment 2, segment 3, segment 4. These segments are under the control of a head. So what are the segments? You can go through your segment reporting concept, which you will learn. Or in a TCS, there could be an IT segment, there could be something on consulting side, there could be something on some other segment. So these segments are there in the business. A strategy for this could be the business level strategy, and within this you can have multiple functions. That is your functional level strategy. So always first decide the corporate strategy. Based on the corporate strategy, you prepare your business level strategy, and based on the business level strategy, you prepare your functional level strategy. Fundamentally is concerned with selection of business in which a company should compete, develop and coordination of that portfolio of business should answer suitability, feasibility and acceptability. What kind of businesses I want to do. Business level strategy, that is at the next level, which is any profit center that can be planned independently. This business level strategy is being prepared by the business level head. Every business is going to have a head. So you will have a separate head for segment 1, separate head for segment 2, separate head for segment 3. These people will take care of the strategy at each of the levels. Then functional level strategy, different functions which can be there for that segment. TCS may not be a very good example. If you take a manufacturing company, you will have R&D segment, you have operations, you have manufacturing, you have marketing, you have finance, you have human resource. So for each of this, you will have to prepare a strategy. So corporate level strategy, business level strategy, and functional level strategy. Next, what is financial planning and what are the components of financial planning? Now, the term strategy and planning can be many a times interchangeably used. You can use these two terms interchangeably many times. What we are doing in planning is we are saying how are we going to achieve the goals which we want to achieve. As I was indicating, I said, how will you clear your CA final exam? For that, you prepare a strategy or a plan. You prepare a strategy or a plan. The plan is going to tell how are you going to clear, your CA final exam. So like that, an organization will prepare a plan which will help them in achieving their goals. So financial planning is the backbone of the business planning and corporate planning. It will help an organization in achieving its results. It will help an organization in achieving its results. It will tell what are the feasible area of operations of a company. The three components, the starting part for any business is finance. So financial resources, how can you use the financial resources to achieve your financial goals by using the various financial tools. Now, just to give an example, you earn a monthly salary of 1 lakh per month. Let's just take 1 lakh is the salary of yours. You have certain goals. What are the goals a person can have? Maybe he wants to travel once a year. He wants to create a retirement corpus. He wants to create a corpus for wedding. He wants to create a corpus maybe for some other purpose. So you have certain goals. How can you use this 1 lakh to achieve these goals is your own financial planning, is your personal financial planning. How can you use this 1 lakh to achieve the various financial goals? How can you achieve? Through the various tools which are available, through the various ways in which investments can be done. So financial planning is using the financial resources with the help of financial tools to achieve the financial goals. Explain outcomes of the financial planning. What is outcome of the financial planning? Once you do a financial planning, what are you going to get out of it? See, any plan which you prepare should help us to measure our performance in future. The very purpose of doing a planning is, see, when I do a batch of classes, I decide saying that I'll start my classes on this day, end my classes on this day. There is a planning which I do. Against this plan, I can measure my actual performance, because ultimately I'll have to evaluate whether my performance is getting achieved or not. So once you do financial planning, you may decide some financial objective. Financial objective. What are the objective you can have? You can have objective of to improve revenues by 45%, to become a market leader, to reduce cost by 10%. So you can have certain objectives, some financial decision making and financial measures. How are you going to measure your objective? How are you going to measure your objective? Financial objectives are to be decided at the very outset too, so that the rest of the decisions can be taken accordingly. Your objective need to be consistent with your corporate mission and corporate objective. As I was saying, your financial strategy is part of the corporate strategy. It is part of the corporate strategy. What is financial decision making? This will help us in analyzing what are the problems that are being faced. What are the problems that are being faced? You say that you want to grow at the rate of 45%. If you want to grow at the rate of 45%, you need extra 10 crore capital. Do you have that or you don't have that? What are the problems you can face and what are the actions you can take? Measures is you want to measure whether your performance is happening or not. You can use ratio analysis, you can use cash flow statement to analyze whether the performance is coming in or not as to whatever you were trying to achieve? Whatever was your goal, are we achieving that or not, is going to come through outcome of the financial planning. Explain the interface between financial policy and strategic management. Let me first touch upon a little bit on strategic management. What is strategic management? Is whatever you would have learned at CA Inter as part of strategic management subject, or you learn it in CA Final SCMP. An organization can implement various models. What are the models? You have a model called total quality management. You have a model called as business excellence model. You have something called as supply chain management. You have a Six Sigma approach. All these are strategic management. Now, what is the interface between financial policy and strategic management? I think that is clearly explained with this first one. The starting point of an organization is money. Ending point of an organization is also money. I've told this line 3-4 times till now, because the starting point of any organization is going to be money, and the ending point is also going to be money. So without money, it is impossible for an organization to meet whatever they are indicating in their strategic management, or whatever they are planning as part of their strategy. So sources of finance and capital structure, that is money which is to be raised, financing policy, are the most important dimension of a strategic plan. After this, whatever money you are raising, you will have to invest them. Another important dimension is investment and fund allocation decision. So whatever strategy, how do I decide my financing policy? I will decide my financing policy based on the overall corporate strategy. Investment policy based on the overall corporate strategy. Dividend policy based on the overall corporate strategy, because I need to see how much dividends can I pay. Can I pay less dividend? Can I pay more dividend? How much flexibility do I have on the dividend payout? Is it another area for making financial policy which will affect the performance. So in short, your financial policy cannot work on a standalone basis. It has to be a combination. In fact, financial policy is the only policy which tries to combine the policies of various functions, various segments, the overall corporate strategy. It has a wider appeal and closer link with the overall organization performance and direction of the growth. How financial goals can be balanced vis-a-vis sustainable growth. This is a very powerful term called as sustainable growth. What is sustainable growth? Is growing at a rate which is sustainable for a long term. What organizations can do is they will first grow at a very rapid pace. You may grow at the rate of 100% for a few years. Then you will grow at 50%. Then you will reach 20%. Moment you reach 20, you are continuing at 20 for a long term. The 20 is called sustainable. But some people do 100, then do negative 50, then do 100, then do negative, then do 100, then do negative. That approach will not work, because what you did is you suddenly brought in some policies because of which you are growing for a shorter period and not growing. Again growing, not growing. Sustainable means having a good performance over a long period of time. Not only short-term performance, focuses on the long term. Focus is always on the long term. How can you perform for a longer period? In fact, a beautiful example given in ICI material. Fuel industry tells its customer not to waste fuel. They do something called as a demarketing campaign. They are doing a demarketing campaign where they are telling their customer, please save fuel. If you save fuel, the revenues of a oil marketing company will reduce, because if you are consuming lesser fuel, their revenues are going to go down. But still they are saying please save fuel, because they are thinking for long term purpose, because this is a non-renewable source. If you keep wasting fuel, you will run out of the resources. Future generation will get impacted. So sustainable means you want to continue over a long term. There are few companies which chase a very high growth. Chasing a high growth has its own challenges. So if you grow at a very high rate for a shorter period and then lose, for example, let's assume you are driving a car You want to drive a car at the speed of 200 kilometers per hour continuously, not possible. That speed is not sustainable. You sustain at maybe 60 kilometers per hour over a normal 60 or 80 is the speed at which you are driving it. Sometimes you will go down, sometimes you will go, but there's a sustainable speed. So the concept of sustainable growth can be useful for planning healthy corporate growth. Healthy corporate growth, because if your sales is increasing significantly, it can put companies into trouble. So illustration I was talking about, fuel industry which does a demarketing campaign. In fact, this is the formula for your sustainable growth rate. You have done this as part of various chapter where we do something called as ROE into retention ratio. So you decide based on ROE into retention ratio what should be your growth rate. If that turns out to be 10%, please operate at 10. If it turns out to be 20, please operate at 20% growth. Don't try to deviate from this level. This is a sustainable growth rate. Incremental growth strategy, profit strategy, all these are variants of your stable growth strategy. Very simple thing, too fast or too slow growth will go against the enterprise growth and development. I don't want a too fast growth. I don't want a too slow growth. What can make an organization financially sustainable? The term used there is financially sustainable. This is what ICI they have distinguished between normally what is financial goal with the sustainable growth, and this is only talking about financially sustainable. See, what can make me financially sustainable? In fact, in the practical world, there's a moment called financial independence and retire early, FIRE movement. There's a movement called financial independence and retire early. Basically, a person wants to retire early because he has become financially sustainable. What can make an organization financially sustainable? If you have multiple ways of generating income or multiple sources of income. When you have more than one source of income, it is possible for us to become financially sustainable, because one business doesn't do well, another business will do well. A lot of companies do diversification because they want to have multiple ways of generating money. So when you have multiple ways of generating money, you are financially sustainable. Do your strategic and financial planning regularly. Have proper systems, proper checks in place, proper risks and control, and have financial autonomy. Write short note on sustainable growth rate. How do you calculate sustainable growth rate? I have told you, ROE into 1 minus dividend payout ratio, or technically ROE into retention ratio. Your sustainable growth rate is basically the maximum rate of growth in the sales that can be achieved. At what rate can you grow considering your ROE? What is ROE? There was a DuPont framework on ROE. There's a DuPont framework on ROE. ROE formula, the return on equity formula is EAES by amount of equity. I had explained the DuPont framework in one problem, I think in your corporate valuation area or on your mergers and acquisition. EAES can be called as PAT by equity. So you can substitute this as PAT by sales multiply sales by assets, and again assets by equity. So ROE is basically nothing but PAT by sales, which is called net profit margin, sales by asset, which is called asset turnover ratio, and this is called equity multiplier. Combination of these three is the return on equity. Combination of these three is only the return on equity. So considering the profitability, which is PAT by sales, asset utilization, which is sales by asset, and debt ratio, which is combination of your debt and equity, which is also called as equity multiplier. So every organization should have a target capital structure, that is at what ratio you want to maintain a debt and equity, target dividend payment ratio, and increase your sales considering whatever is feasible by ROE into retention ratio. Often a conflict can arise if growth objectives are not consistent with the value of organization sustainable growth. Now, as I said, Sustainable growth is nothing but ensuring healthy long-term growth for an organization. What is the conflict which can arise is sustainable is saying you should grow at the rate of 8%. Growth objective is saying I want to grow at 20%. That is not good, because if you're trying to grow at a very high rate, you will not be doing good for the future generation. So an organization, this is almost discussed earlier also, an organization should ensure that you are growing at the correct rate. In fact, I think this question 13 is nothing but this: how financial goals can be balanced with sustainable growth. The same solution is only there. So I could have discussed this as part of that. What makes an organization sustainable? This is what I was talking about. ICA has given two questions. One is organization financially sustainable and organization sustainable. Sustainable is staying for a long-term period. For sustainable growth, you need to have a strategic direction, clear strategic direction. Based on clear strategic direction, you bring in the three fundamentals of a business: clear strategy, management, and financial resources. So have good management, competent staff, have proper resources, financial resources, and ensure that you are sustainable over a long-term period. Okay, there's one question which is there, which is to calculate sustainable growth rate. Mr. X has submitted the following data: total assets, total liabilities, net income, dividend paid, sales. Mr. X wants to know what extent sales can be increased without going for additional borrowing by using a concept of sustainable growth rate. SGR is nothing but ROE into retention ratio. ROE into retention ratio. Now ROE is net income 12 divided by amount of equity. What is amount of equity? Is 250 minus 200. Amount of equity is 250 minus 220. Sorry, 250 minus 220 will give us something called as the equity component, which is there. So 12 by 30 is 40%. Retention ratios, dividend is 4.5, which means retained earnings is balanced. Retained earning is balanced on a base of 12. So 62.5%. You can combine these two. Which says it's 25%. ROE into retention ratio. So wants to know how much sales can be increased. From your 100 lakh sales, you can go up to 125. You can go up to 125. So I'll quickly summarize what we did here. We first understood what are the new roles of a CFO. The new role is he can focus on risk management, supply chain, M&A part, and ESG financing. Three essential elements of a business: financial resources, management, and a strategy. What is strategy? Long-term direction. What are the functions of SFM? It is basically searching for your investment opportunity, finding out the best opportunity, doing a proper mix of debt and equity, and establishing systems and evaluating the performance. What are the decisions you take? Financing decision, investment decision, dividend decision, and portfolio decision. Different types of strategy: corporate level strategy, business level strategy, and functional level strategy. What is financial planning? Financial planning has basically three components: maximizing the financial resources to achieve the financial goals with the help of financial tools. What is the outcome of the financial planning? Once you do financial planning, you will get to know what are the objectives, some decision you will take in between, and what are the financial measures to assess the performance. Interface between financial policy and strategic management: starting part is money, ending part is money. So no strategy can work. Our financial strategy cannot work in isolation with the other strategy. There is a link. How financial goals can be balanced with sustainable goal? A sustainable growth is the long-term healthy growth for an organization. You should not chase a growth strategy. You should chase a sustainable growth strategy. So there can be a conflict which can arise between the growth objective and the sustainable growth part. Example of a demarketing campaign we saw, which is for fuel industry. How can an organization become financially sustainable? Basic thing is having more than one source of income or having more than one ways of generating income, proper systems in place, having proper financial autonomy, adequate systems are there, financial planning is done. Sustainable growth rate is basically the rate, maximum rate at which you can grow without compromising or without taking any new loans and all. Formula for that was ROE into the retention ratio. The conflict part is already discussed. What can make an organization sustainable? Again, the three fundamentals of a business: having a good management, which is a competent staff, having a good strategy, clear strategic direction, and you will have to have adequate infrastructure and resources. And we saw one problem on calculation of SGR. If there are any doubts, you can just message me. Thank you.